Dividend stocks have two benefits for investors. One, you receive plenty of cash flow, and two, you have the potential to realize capital gains. So this video is going to cover three different dividend stocks that provide the best of those scenarios. You're getting a respectable yield, a lot of dividend growth potential, and you are getting returns that can beat the market. So let's get into it. The first dividend stock is Meta Platforms. The company has 3.27 billion daily active users across its social networks. That is up by 7% year over year. And that large user base gives Meta Platforms a lot of flexibility with how it runs ads and how much revenue it can generate from those efforts. We saw that in the second quarter of 2024, where revenue was up by 22% year over year, while net income was up by 73% year over year. Headcount for the company is only down by 1% year over year compared to Q2 2023. So a lot of the initial efficiency was firing people to increase the profit margins, which you don't want that in the long run because you are displacing workers. And also from a company perspective, from a shareholder perspective, if you have to continue to fire people to increase profit margins, then that can come back to bite you in the long run, since you have fewer talented workers who can drive revenue growth and who can make sure the profits are in a good place. So it's nice to see that headcount was relatively stable while the company was able to generate 73% year over year net income growth. The high net income growth makes the PE ratio more attractive for this company. You usually see companies with 20% plus year over year revenue growth having much higher valuations, especially when we're looking at the net income growth, which suggests that the forward PE ratio is going to be quite low compared to what the PE ratio is right now. Meta Platforms has a good history of beating the stock market. It's up by more than 40% year to date and has gained more than 160% over the past 5 years. And the company has poured a lot of money into stock buybacks and the dividend. A lot more money has gone into the share repurchases. So that suggests that Meta Platforms has the capital to support a annualized double-digit dividend growth rate for many years. The company also has more than $58 billion as its cash position, really suggesting that even though the yield is low right now and the first quarterly dividend is 50 cents per share, that's the first dividend that Meta Platforms instated, we should be seeing meaningful dividend growth in the years ahead, making it a dividend growth stock to monitor. The second stock on this list is Walmart. The global retailer has raised its dividend for 51 consecutive years. That includes a 9% dividend hike earlier this year. That's the highest dividend hike Walmart has issued in more than a decade. It's the leading grocer, so a lot of people are going to Walmart to buy the essentials, but they may notice some other things in the store and decide to add more items to their shopping cart. Now, e-commerce has been a bright spot for Walmart, with revenue growth above 20% year over year in several quarters, including the first quarter of fiscal 2025, which saw revenue up by 6.0% year over year. Now, e-commerce isn't the only bright spot. Advertising also did pretty well. That was also up by more than 20% year over year. However, advertising is a smaller component of the business. It only made up 3.4 billion of the company's revenue in fiscal 2024, which it still sounds like a lot, but if you're looking at the total revenue that Walmart generated, 648.1 billion in fiscal 2024, the advertising is just a very small slice. It's nice to see it growing. It definitely doesn't hurt to see advertising grow, especially since advertising is known for higher profit margins compared to retail, which generally has lower profit margins. So it's good to see that it's growing. It's just not a major catalyst that's going to make a big impact on earnings for at least the next few years, but it's nice to see that we're experiencing growth in this area. E-commerce is a bit more meaningful, as that part of Walmart's business exceeded $100 billion compared to the 648.1 that they posted in fiscal 2024. So it's nice to see that component still growing. Walmart is better at resisting recessions compared to other companies because it has a lot of essentials and it's known for more than 60 years as the place you could go to buy low-priced products and services. So if there are any economic slowdowns, based on the jobs report, we are seeing an uptick in unemployment, then Walmart would be the go-to place as people get more protective over their budgets. The final stock on this list is Texas Roadhouse, a steakhouse chain that experienced 14.5% year-over-year revenue growth and 46.0% year-over-year net income growth in the second quarter of 2024. Those results and others have helped the stock more than triple over the past 5 years, and it's up by roughly 40% year to date. What's special about Texas Roadhouse is that it has a reasonable valuation compared to other fast food restaurants, roughly a 30 PE ratio. The growth rates are good at a time where consumers are pulling back on fast food restaurants. We've seen McDonald's, we've seen Starbucks reporting slower growth and deceleration in certain areas. So the fact that Texas Roadhouse is still able to deliver solid year-over-year revenue growth and also year-over-year comparable sales growth. We saw 9.3% year-over-year growth in company-owned restaurant comparable sales, and the franchises saw an 8.3% year-over-year improvement in comparable sales. So Texas Roadhouse is still able to attract people. It's still able to command solid prices, whereas you see other fast food restaurants that aren't as known for as healthier venues, they're starting to see some pushback from the price hikes and the current cost of all the different food options. Now, at the end of the day, the healthiest food option is if you're able to make stuff at home, but fast food restaurants, when they are able to provide healthy alternatives that are easy and convenient, that's going to be something that draws people in. Texas Roadhouse has been able to do that at a point where others aren't doing as well in that regard. The dividend is also pretty respectable, almost at 1.50%. And you see a double dividend growth rate. That's been quite common for a Texas Roadhouse. So you are getting a dividend growth stock that has meaningful historical returns, and the revenue and net income growth combined with a decent valuation suggests that the stock can rally from current levels. Let me know what you think about these dividend stocks and which ones you are looking at in the comments. I look forward to hearing from you, and I'll see you in the next one.